The snow outside there. Is that not gorgeous on
Have I
on
seen
the
the snow
Ohio
outside? Oh, I love
trees?
it.
It's a beautiful Thursday in Ohio. We welcome you in. We are thrilled that 31 of you are watching right now. That's incredible. We just started the show. Paul, I say it again, and you
Our
and
first
I
ever live stream, I think we hit a peak of 31.
I was going to say, yeah, folks, if you're watching the show, we welcome a lot of our new subscribers. Paul, talk about the subscriber count that happened over this evening. It's like
Guys,
Christmas came early for us.
we did a Pfizer video yesterday, and immediately it blew up. Our record for most subscribers gained in one day, I think was around 71. Officially, when I say record, I check at 8 a.m. I officially log it at 8 a.m. every day. In the last, from 7:30 a.m. the day before to 7:30 a.m. this morning, we gained 400 and something like that.
Over 10% of our total count we just got in the past day. Paul and I text each other like giddy schoolgirls about every 17 minutes, and Don too.
It's been awesome.
It's been incredible.
We of course appreciate it. We have a lot more to go, but it just shows that people want to learn more, want to understand more, and we like talking about it, so it helps out for everybody.
Yeah, again, I want to thank everyone. I'll be thanking you throughout the whole show. We appreciate it. As always, we love for you guys to tickle that like button. That'll help us with the YouTube algorithm. And, Paul, I would say that one comment we got, I know we're not just always going to focus on negative comments, but someone said, Paul, why would someone with so much money and such a vast portfolio worry about making money on
that guy who
YouTube?
said that? Guy said that.
What about making money on YouTube? Folks, I will let you know, if you are watching some of our competitors on YouTube who are literally sitting in their dorm room pretending to analyze stocks with, I would imagine, not that much wealth behind it, or knowledge or years of experience. This show that you're looking at right now, Paul, I generally calculate it's cost us over the past 2 years about $250,000 to run this show.
Is that how much
I think so. With the cameras, with the staff, there's 2 people on cameras, Don and Nate are running the cameras right now.
It's definitely $100,000 a year right now.
Yeah, so all we ask is nothing from you. All we got to do is just smash that that thumbs up button.
And subscribe, tell your friends.
And if you want to join our Patreon, we will get to this later, of course, more in depth, but our Patreon channel has been blowing up as well. It's Everything Money on Patreon. Paul, we hit like 60-something patrons just in the past month. It's been incredible. And what that will give you is full access to Paul, his mind, the trades that he makes on a daily basis.
There are 3 levels.
There are 3 levels. You got to get in that high one. But the low one, you will get in a Discord channel where you'll learn about everything that we're teaching here, a disciplined approach to investing, moving forward with your money.
And
go ahead, Paul.
The app and website are being developed right now. We're going to have the website 3 to 4 months from now. We'll have the app in 9 to 12 months. Anybody who's an active Patreon user gets the app and website for free. I just had my contract signing today with Morningstar. We went over everything. It's happening. It's great. It's wonderful. That alone makes it worth it. It alone makes it worth it just to be able to go on. Instead of waiting for me to do the 8 pillars, you'll be able to go on the app, plug it in. The 8 pillars will tell you, worst case, $8 a month through the Patreon. It helps for me to pay the bills around here, pay Don, pay Seth more. They get bonuses when we do things. I'm not trying to be, I'm just sitting there saying, guys, there's a lot of value here, and I want people to pay for value. That's why I do this. It's not because, why is a guy like this who claims to make so much money? It's just because I'm still a business person. I still want to be paid for my time. And I want to sit there and do it, and YouTube's going to pay me. And if you want more access to me, that's how you get it.
I welcome in some of our amazing patrons here. I see you in there. Nick, welcome Alon Boone. There's David, of course. David commented, one of our patrons commented this, Paul, yesterday. He was like 17 hours early, claiming that this was his comment chat to I see you there, Moosehead. Moosehead says, I've devoted, I built myself a portfolio devoted to dividend growth, and he's excited to see what we have to say today, Paul. So I want to get, Paul, your ins and outs about Matt Jensen says, how do we get less access to you, Paul? That's a great question. Some people want that. A lot of the women in Paul's life.
I'll block your number, Matt. I have no problem doing that.
Yeah. Paul, talk about just generally, I'm new to this, and I would say, Paul, 2 years ago or 3 years ago, I was definitely new to this until you came into my life in terms of investing. But one of our dear friends actually just recently decided to take his portfolio into his own hands. He was paying someone I'll let you know after this, but I would say in general, because of their fear of maybe doing the wrong thing, they actually chose to let their bank just keep the money for a 2% return.
Oh, how are they even getting 2% of their bank?
I don't even know, but he's making the decision to put his money in his own hands and not hire someone to do it. And of course, as we described in fellow episodes, we have a zillion episodes underneath us here if you scroll down. But as we described, if you put the money in your hands, you're going to save a gazillion dollars in doing so.
Yep.
But Paul, go ahead. Tell us your just overall general stake idea on dividend stocks, why people are
We're
drawn to them.
We're going to do more than just general.
Go ahead. Oh,
okay.
Please do.
So dividends, when a company earns $10 in a year, one of the ways in which they can pay their investors, because most times if somebody earns $10 and they keep it, it's called retained earnings, the money in the company. You as an investor might sit there and say, well, I'm not seeing any of it. You really are seeing it because you're owning a piece of a company that's building up a cash pile. But obviously, not everybody learns from everything money, so they can't learn from me. They want to see some sort of money back in their pocket. So a company will pay a dividend. Let's say, for example, they take $10, they make $10, they pay $2. They're paying out 20% of their net earnings into dividends, okay? That is their way of saying, hey, thank you for being an investor. We're going to give you some money. It's in your hand no matter what happens. Dividends over long periods of time have been shown. I think I read a stat somewhere. If you only bought dividend-paying stocks since 1928, you'd outperform the S&P by something like 2.5% a year. I don't know how true that is. I've never back-tested it. I've never looked at it. First off, because the S&P 500 didn't even exist in 1928, so it would be based on S&P 500 comparables, et cetera. But dividends are a great way for an investor to feel like, hey, I'm getting a check. I'm getting something for my return. Even if the stock price is stagnant for a long time, I might be getting 3 to 4% or whatever the number is right now. Keep in mind, the S&P overall is paying about a 1.6% dividend. So if you own SPY or all the companies individually, you're going to get about 1.6% per year on your money.
SPY is the S&P ETF?
Correct.
Okay.
So that means if you have $10,000 invested, you can get about $160 a year. Okay? Not great, not bad. Now, historically, that number is usually around 4% if you go back to like 1870. So it's pretty low right now. However, the one thing I always urge people caution. I remember a story in 2004, I was buying my first piece of real estate. And my lawyer was the trustee of some trust. And he was told we need dividends. So he's like, oh yeah, I went in there and I just searched. High dividend was GM. And I was like, well, do you think the dividend is safe? He said, well, of course it's safe. They're paying it. They wouldn't be able to, if they're not able to pay it, then that's how, I'm like, okay, that's not true. A lot of times what a company will do is they will do what's called create a dividend trap, or will have a dividend trap scenario where the stock price plummets. So if, let's say, for example, the stock is at $50 and the company pays a $2 dividend, that is 4%, right? Right. Now what happens if the stock price goes to $25, call it $24? Let's call it $20. They're still paying the $2 dividend. Now it's a 10% dividend. That's pretty good. Mm-hmm. What companies might do sometimes is go, hey, you don't need 10%. We're going to cut this dividend in half. You're still making more. You're getting 5%, and we're saving cash that we can use to grow the business, et cetera. But what you need to know is it even a supported dividend? We talk about this all the time. Can the company actually support the dividend? Free cash flow. We always talk about this, guys. It's my favorite metric. Free cash flow is cash from operations less capital expenditures. Now, this cash at the end of the day, they use to pay dividends, make acquisitions, invest in more growth, hire people, etc. But if this free cash flow number is less than the dividend amount, you have a problem, even if it's not less. So let's say, for example, there's a company, and let's say the company has a market cap of $10 billion, and they pay a 2% dividend. That means every year, they're responsible for $200 million in dividends. What you want to see is you want to calculate their free cash flow and make sure it's a pretty healthy amount above this number. Because if it's, let's say, for example, they have $220 million, that's not much room to go with. You're pretty tight here. Any sort of backlash, any sort of like fall in revenue or profit, it's going to cause a problem. Let's say they make $1 billion a year in free cash flow. That's pretty solid. They're only paying out 20% of their free cash flow. Now, your next question might be, okay, well, what's a good metric for that? I don't know. It all depends on so many factors. Does the company have a good gross margin? Do they have a good profit margin? Do they have increasing debt, decreasing debt? How much debt do they have? How much is going? There's so many factors. The less you know, the higher you want this margin to be. You've seen me when I talk about it. Whenever we talk about a company that has dividends, we say, how safe is this dividend?
And if this sounds if this already sounds confusing to you, We welcome you to follow along the channel, subscribe. We will show you how to calculate the free cash flow growth. Paul opens up the Y charts and shows you exactly the calculation, how much money they have and can they pay out their dividend. This is part of our 8-pillar analysis that we do on our show. If you're new to us, Paul, talk about the 8 pillars and what our patrons are getting in the future.
So the 8 pillars, when we first started this channel, Seth said to me, Paul, what do you do to find a stock? And I just said, I look at this. And we
all of which was news to me because, again,
all news to Seth.
What I always did for the past decade was what was the price of the stock and what is it going to go up or down? That's how I buy. If that's how you're buying, you're in for a treat because Paul will teach you what he does.
It happened to be 8 things. It could have been 9. It could have been 7. And there are other things I look at. But before I go any further in the stock, I always looked at these 8 things. And Seth goes, okay, call it 8 pillars. Great, we're done. So it has a name to it. But I look at these things because it kind of gives me a 500-foot view of the company and say, okay, it gives me a general feel for where the company is, how they're doing, etc. In no way, shape, or form is the 8-pillar analysis telling me to buy or not. It might tell me not to buy a stock, but it's rarely telling me to buy a stock. You still need to go deeper and understand the qualitative aspects of the company. How are they growing? Are they not growing? Do they have a good management team? Are they ethical? What's their market like? Are they big? There's all these other aspects we need to understand before we buy a stock. The 8 pillars can be used to eliminate a stock. I thought about that recently saying, but at the same point, there's going to be a situation, I'm sure, where they might be one check mark and you go, I'm still buying the stock. If something's cheap enough, you still want to buy it. As my friend Gary Mashuris says, check out youtube.com/Gary Mashuris. He's got great videos. He says the bigger the discount, the less research you need to do. If you put a price on a company, you sit there and say it's worth $50. If it's selling for 48, you got to do a lot of research, make sure that 48's right. If it's selling for 10, do less research. Just make sure you're getting your money back or whatever the number is. But the whole point is, when I was doing these 8 pillars, I created this. It's been a hit because it's an easy way to get a high-level view of companies. And that's why I decided to create this app and this website. The website will have, everybody's been talking to me about Y charts. I'm actually buying the same data that Y charts buys. I'm going to have it organized the similar way on our website. When we get the website ready, I will only be using the 8pillarstocks.com website to show you all this data. And the app will be there. You can type in 1 stock or 10 stocks, and it'll give you your 8 pillars, which ones are check marks, which ones are X's. And that'll be $15 to $25 a month. It all depends on what we add, how we do it. But everybody who's a Patreon gets it for free.
Should we get into analyzing stock?
So this is what I want to do. I also want to look at the dividends. I want to look at this one right here. So we have Verizon here. Verizon's the first company we're doing, correct? Everybody knows Verizon.
This is off the Patreon request line from David, our dear friend David.
To calculate how much they're paying in dividends, you look at the market cap, $248 billion. Let's call it 250 just to be safe. 250 billion. Then you come here and look at their dividend yield, 4.19. Let's call it 4%.
Okay.
That is $10 billion a year. That's a big number, guys. So when we do the free cash flow in 0.7 and 8, we want to make sure they have significantly more than they need in order to do this. Now, something that's been very popular lately has been
your shirts. I told you you've been looking really good. In fact, Don, I got home and rewatched some of our videos, and you were looking shredded. You should be very proud.
Shredded?
I'm telling you, you look jacked, bro. For a little chest,
nodding his head.
Yeah, for a little chest nerd, you look really good.
Anyways,
go ahead, Paul.
Because remember, one thing that's been very popular lately has been buying shares back. You buy shares back with your free cash flow or with debt. So you want to make sure that they have enough to pay this lovely dividend. That's a very important part. But let's do the 8-pillar analysis.
Okay, pillar number 1 is PE ratio. This is price to earnings, folks. We want this less than 20.
It's 13.57. Historically, it's around 15 or 16. So this is a check mark here.
I like that so far. Okay, how about profit margin? We want this more than 10%, Paul. That's where you want it.
13.8%. Check mark there.
Check it out. Okay.
And the gross margin is 61%. Remember, gross margin is every additional dollar they sell, how much of that goes to the bottom line. That factors in no overhead. It's just the direct cost to generate revenue.
I would say, folks, if you have other questions while Paul's going through this, Trader Mo, our day trader specialist, is on the chat. And, of course, if you have really simple questions, my 10-year-old son, George Kerchanan, is on the chat, and he can inform you about other hilarious children's YouTube channels. Paul, let's go to revenue growth, which is pillar number 3 over the past 5 years, baby.
All right, this is technically getting a check, but it's not pretty.
Tell me about
131.6 to 131.9. And look in between. Fell to 126, 126, 130, 130. So it is a check mark, but it's not the prettiest. Now, I don't know, there was some acquisitions made here or maybe some dispositions or whatever.
Let's do
Net income.
Yep, profit growth.
17.9, 13, 30, 15.5, 19.26. Check mark.
Kind of weird though.
Speaking of dividends, people are going to say to you, well, Paul, should I look at the profit for dividends? Sure. Profit and free cash flow over longer periods of time should be very close to each other. I just like to go immediately to the free cash flow statement just to say, let me just see what it looks like here. Because a company could take on debt, and the free cash flow statement will really show you how much money the company is actually bringing in after reinvesting back in themselves. So, according to this, they can support this dividend of $10 billion. So, next one.
Let's look at pillar number 5, which is the number of actual shares outstanding in the world. We want this going down, the shares down.
It's an X, but not by much.
Oh boy.
4.08 to 4.14 billion shares.
Just
so not a ton, but it is going up.
How about current assets greater than current liabilities, which is pillar number 6?
Why don't you explain what that is to people?
Oh, God.
I'll pull it up.
Well, while I explain it poorly, Paul will correct me in about 17 seconds here, but current assets is really their cash on hand, the money they have in the bank, and their liabilities is things they owe. So comparing it to someone like yourself, this is your mortgage, Paul, your car payment.
What is this, by the way? What is this?
3,400, it's a number.
What does that mean, though?
I don't know.
Subscribers, we just hit.
Oh, wow, Paul.
Right here, like Don's laughing. He knew where I was going with that.
3,400
we just hit 3,400 subscribers on the nose.
We were under 3,000 just yesterday, folks. So we
just
really
yesterday morning,
appreciate
we were under
all you out
3,000.
there. I love you. I love you. I love you. I love you, Paul. Keep going now. Let's do current assets greater than current liabilities.
Cash on hand, 38.5 billion. Current liabilities.
Go
a little bit lower. 36 billion. So it's an X.
Uh-oh.
So they don't currently have enough cash on hand to pay for their current liabilities. Now, does that mean avoid? No. About 20% of companies deal that way. I don't understand why that is, what their payment structures are, et cetera. Like there might be a very good payment structure, and that's why they do that. I just don't like it because to me, it's like I have $10,000 in the bank and I have $12,000 in bills due in the next, short period of time. That's not a very good feeling. But, it's not a deal breaker, but it's something to consider.
Mason, I see there. Dom, Owen, I see there. Projected. Dom, I see. Good job, guys. Thanks for following along. Paul, this is pillar number 7, which is free cash flow growth, cash from operations minus capital expenditures. What are capital expenditures again, Paul?
Capital expenditures are your investments back in your fixed asset. Now, as I read more, capital expenditures can be split up in 2 ways: maintenance capital expenditures and growth capital expenditures. If they do isolate the two, you should subtract out the growth ones, because maintenance capital expenditures are the capital expenditures they make to maintain the business at where it's at. Growth capital expenditures are, hey, what are we doing to grow the business? We want everybody to be able to do that. So, Seth, are you ready? Well, first off, we'll do 12 billion here and 17 billion here. So it's definitely a check mark. Now remember, they needed 10 billion. So they have enough money to pay. $7 billion, not bad. I mean, it's not insane. It's not terrible. $7 billion is a pretty good number. So 12 and 17, Seth. And then 4, 7, and 16.
The average free cash flow over the past 5 years is 11.2, Paul.
Okay, 11.2 billion. Now, this is the question we always get. I always want to multiply it by some number. What's that number? I've said 20 in the past. Now, the 20 number isn't set in stone. What you need to look at is, if you think about it, if a company is going to grow fast, should you be willing to pay more money for that company? The answer is yes. If a company has fast revenue growth, fast profit growth, you can justify paying more because it's going to grow into a value. If it's growing very slowly, then you don't want to do that. You remember the revenue here. The revenue is pretty much flat for 5 years. This is a company where I want to pay less, but it's a good brand. This is a subjective number.
This is Verizon. Keep going.
This is a very subjective number. We don't know exactly what number you want to be here. 15, 12, 18. It depends on what you think about the company and its potential. Should there be a discount because it's not growing? Yes. But it's Verizon. What are the chances that Verizon goes under? Would we all be shocked if Verizon was out of business in 5 years? The answer is yes. We'd all be shocked. So should it get a premium for that? At the end of the day, these are things you have to weigh. For Verizon, I'm sitting there saying I want to multiply it by the historical average of 15 times earnings, because cash flow and earnings are about the same over long periods of time.
168.
170 billion. What was their market cap?
250 billion.
Yep. So we need a drop of 30% for this to be selling for what it's worth. Now remember.
Oh, go ahead, Paul. Actually, I was going to say, so just to recap, folks, this is Verizon stock. We like the PE, the profit margin. They have revenue and profit growth. Their shares are increasing, not decreasing. Their assets, they can't cover their assets, no pun intended. They have good free cash flow, but their price of free cash flow is still too high.
Now, this is my Excel sheet where I run my models. And I make my assumptions over here. I make my assumptions over here, my return that I want, and my profit margin assumptions. 5-year average profit margin is 14.9%. On bigger, mature companies, I tend to keep the profit margin the same. If you want to do a discount for it, by all means. But revenue growth, I definitely do it a little bit different. But this one actually has, according to this, negative revenue growth over the last 20 quarters. But here, the price is 60, and I said 30% discount, make it about 42, and my price is about 45. So if I pay $45 a share for this company, I'm expecting to make about 15% a year for the next 5 years. That's pretty much where we stand right here on Verizon. Now, remember, this is all part of a process. It's the qualitative part of it. It's what makes investing an art. I don't know the exact number. All I know is if Verizon tomorrow was $30, I'd be very excited. I'd be extremely excited if Verizon was $30, right? Let's go see when was the last time Verizon was $30. Probably a long, long time ago.
Jonathan, out here, I'll try and slow Paul down a smidge when it comes to the math. I think the free cash flow gets folks just a smidge. So we'll make sure we slow it down for you guys.
The last time, I mean, it's been since 2012, but look at this company. It has gone nowhere for how long? I mean, it's gone nowhere for 6-7 years, but it's paying a 4% dividend. So I want to buy it at a discount so that I can get some growth out of it. Now, the free cash flow number, what's the part I need to slow down on?
People are just saying, Jonathan just said, can you slow Paul down on the math and break it down a little bit more? We'll work on that for sure. Oh, you're doing great, Paul.
Absolutely. Okay, so that's pretty much where I stand on Verizon. We haven't looked at technicals in a while. So remember, technicals are the 200-day versus the 300-day moving average. If you bought these on a large basket of stocks, you buy when the 200-day moving average goes above the 300-day, and sell when the 200-day goes below the 300-day, you beat the market by about 1.2% over a 20-year period. That's when we back tested it. If you look here, there was a sell signal. The blue line's the 200-day, the orange line's the 300-day. There was a sell signal back here. If you look back here in March of 18, there was a buy signal at about $48 a share, and there was a sell signal at about $58 a share. So you'd have made some money on doing that. And this is over long periods of time. You won't always make money on it, but if you keep consistent and always follow the rules, you can do better than the market. You're going to have a lot of costs for taxes, but you can do better than the market.
Benjamin is correct, Paul. He said maybe we should just do a free cash flow video for some of our new subscribers to sort of break it down.
We've talked about that.
Yeah. David said, can we look at the dividend history, the increases,
great question. This is what I've forgotten in the early part of the dividend.
Go on.
What's important in dividends is to make sure, one, the company is consistent with it. Because the last thing you want to do is invest in a company that's giving you a good dividend, and their history shows that anytime there's a blip, they stop the dividend or they cut it.
Mm-hmm.
So there are websites that'll show you dividend-paying companies that keep it consistent and increase as their profit increases consistently over time. They do exist. I think there's a thing called a Dividend Aristocrat ETF or something like that, where it'll just invest in consistently paying high dividend companies. Because at the end of the day, if you're a big company, you're generating a lot of cash flow, and you have nothing to do with that cash flow because you're so big, how do you reinvest it? A good way to give it's back to your investors.
Chris is saying that Seeking Alpha is a great way to look at this.
I like Seeking Alpha. I used to be a contributor on there. I just go there now and do, what I try to do with Seeking Alpha is whenever I have a thesis, I go to Seeking Alpha and look up the company and see what people are saying about it, both sides of it. Like, okay, somebody who agrees with me and somebody who doesn't agree with me.
Ayrton from Peru is always on one of our patrons, of course. Moo said, I see you there. All bank stocks cut their dividends in recessions. Is that true, Paul?
I don't know if that's exactly true. Let's look at, I don't know if that's true, but the big ones, in the Great Recession, a lot of banks did cut their dividends, but for reasons of, banks have very specific capital requirements. So they had to keep their capital safe, as well as they were borrowing money from the government. So they didn't feel right that they were getting bailed out by the government and then they're paying investors out. It wasn't like, it was kind of like a, hey, that's not really the right thing. Keep your cash to make your bank better and save jobs.
If you guys and gals are watching, make sure you tickle that thumbs up video real quick. Just one little click really helps us out. You don't have to pay a nickel for any of this stuff. Paul will be giving you this on twice a week in a video. God, Paul, twice a day we're doing videos. It's completely absurd how many videos we're putting out.
Somebody mentioned this Dividends Aristocrat, NOBL.
Go on.
So let's look at their See, I can't look up their dividend. That's what sucks. They won't show me their dividend.
And
exactly.
One of our viewers, students, I see they're asking about AMT. We will get to some of these. Probably we have some Patreon requests, folks. If you're in our Patreon and you request to see some of these stocks, we're going to do these first because we love you and they're supporting us. So if you want to get after it, then you jump on that Patreon and we'll do your request. Go ahead, Paul.
So here's what I'll say. The current dividend yield in NOBL is 2%. The expense ratio is 0.35.
I'm sorry, what company is this?
This is not a company. This is the ETF for Dividend Aristocrat.
Oh, okay.
Somebody suggested it in the chat.
Sorry, go ahead.
You're about 1.65. Remember what I said about the S&P? They're about 1.6%. You're basically to get the same thing. Like I don't know how good these companies are, et cetera, but the good news is for everything, for the 8pillarstocks.com and the 8pillars app, one of the things I'm going to create down the road is where you can input 20 or 30 stocks. It'll give you an overall pillars of those stocks combined, like it's one mutual fund or one ETF. What are you looking at, Sethi?
I'm just looking. The Nostradamus show said a large portion of my portfolio are filled with dividend kings as well.
I don't know what dividend kings are.
Nostradante, tell us what that is. Okay, Paul, would you like to do a new company? Are we done with Verizon? What's your take home? No go at the moment.
Yeah, it's not a go right in the moment. And the thing is, I thought about myself, like, okay, well, what if I buy? What if I sell some puts on it? Verizon is one of those big companies where the puts are going to be absolutely garbage. Trader Mo can talk about it, but should we pull up puts? I kind of like the idea.
No. I think puts would be over the head at the moment, Paul. I'd like to keep. We have so many people requests.
I get that, and that's why I want to create. Let's go ahead. Abbvie.
Abbvie is a great one. Now we've had a lot of requests over the past month for Abbvie. What do they do again, Paul? Is this a
pharmaceutical?
Pharmaceutical. That's right.
Yeah. So Abbvie is a drug company with strong exposure to immunology and oncology. My father's an oncologist. The company's top drug, Humira, represents close to half of the company's current net profits. Wow. So this is something to consider.
Go on.
When it comes to pharmaceuticals, you want to see how their pipeline is. And also, Humira is taking up half of their company's current profits. When these companies create a drug, the second it hits generic, that's a problem for the company.
How long is that, Paul?
I think it's like 17 or 20 years. How long is that?
I thought it was much shorter. I thought it was 4 to 7 years. Maybe I'm completely wrong. If someone knows how long people can start copying drugs,
is like 17 years, 20 years, something like that.
Okay.
So Humira,
Chris says
I've
they
seen
lose
commercials through Humira. Have you seen it?
Chris says they lose the patent in 3 years, but someone else,
I don't think so.
RJ Wolf says 7. Ayrton says 20. So who knows?
Let's look it up right now. How long do drug companies hold patents on drugs? 20 years.
Oh, 20 years. Okay.
There we go.
Okay. All right, Paul. Abbvie. Let's get back to
3 years. Why would they invest billions of dollars to get 3 years?
I don't know. I don't know.
Okay, so
what is the market cap for Abbvie? Sorry, Paul. Keep going.
185 billion.
Okay, very nice. 185.
Okay, PE is an X. It's at 22 currently. We want it under 20.
That's
profit
close,
margin
though.
is a check.
What's their profit margin?
17.9.
That's pretty good, right?
And a 60% gross margin. And dividend, 5%.
Ooh.
So 5% of 185 is, what is that, 7.75, 9.25.
Yeah, 9.25. You got it
Christ,
right.
9.25 billion.
Mm-hmm.
My brain went dead there. Okay, so they have to generate 9.25 easily in free cash flow to pay for this.
Okay, let's do pillar number 3 is revenue growth.
Pillar number 3.
Revenue growth.
22.9, 33.27, check mark. That's pretty nice growth there. 10 years ago it was 15, so it's doubled in the last 10 years.
Wow, profit growth. I assume that's doing well.
I would imagine so as well. Okay, net income, 5.1 to 7.9. Check mark. With a big jump here in the last year.
Check, please.
Check, please.
Chris said their stock is getting beat up because of the patent expiration, so they acquired the patent for Botox.
So wait a second. They're losing Humira's patent? Is that what's going on?
Maybe.
So this is important, guys. This is part of the aspect that you don't want to go on the past. You want to see what the prospects of the future are.
Chris says yes. David says yes. Milan.
When does that patent run up?
Next year.
So what you want to do is go look at the history of other drugs. How much people will still buy the real version?
Humira comes off 2022, 2023. So.
Wow.
So
that's gonna be a big. Half their profits are from Humira. That's a problem, guys.
And John says you haven't been singing as much during the show.
I used to sing.
Well, like you'd mutter words and one-liners, so keep that up. People love it.
1.625 billion shares, 1.48 billion shares. Check mark.
Okay, shares outstanding is going down. It's good stuff. How about current assets greater than current liabilities, Paul?
Okay. 23 billion in current assets and 24 billion in current liabilities. So it's an X there.
Uh-oh.
Not by much, but it is an X there, which I'm kind of surprised by that.
Chris, Michael, I see you there. We did an ETF show all last week. So you're welcome to just jump back a week and see a whole 90 minutes on ETFs. Keep going, Paul. Let's do free cash flow, Paul.
So you'll see right here, guys, very low percentage of their free cash from operations goes to capital expenditures. That's awesome. Okay. So they had $7 billion 5 years ago, 12.8 check mark there. But if you remember, their dividend was 9.25 billion. That doesn't leave much room there.
You say "but" really loud always.
But it's like EBITDA. Like he always says that.
Okay, do the middle ones.
7 and 12.8, and then 6.5, 9.5, and 12.8.
The free cash flow average over the past 5 years is 9.72, Paul.
Okay, guys. Now, what's the multiplier? Now, remember, free cash flow. This is like the PE ratio over long periods of time. That's why I picked 20, because the PE we look at is for less than 20. This company is still growing, but in 2 years, they're losing their half profit moneymaker. You got to pay very little for this company if they don't have a plan. Now, go listen to some earnings calls. Go call the company. Do they have things in the works to be able to overcompensate for Humira? I don't know. My take on this one is I don't care what this multiplier is. At the end of the day, this is more about what is their plan for the future. If they're losing Humira, which is half of their profit in the next couple of years, you need to make sure you think there and say, listen, they're going to compensate for it by doing this, this, and this, and it's going to keep the profits up. That's what matters here. So, what was the market cap? 185
billion.
I mean, I don't know. I really don't know what you pay for this company. That's the thing of investments, guys. And the way some people look at it as other value investors would say, if you don't know, you should avoid it. And the reason being is wait till the path is clear to another big revenue generator. Half of their profit comes from Humira. That's incredible. Half.
So Abbvie, the PE is good. Profit margin is not good in Paul's take. The revenue and profit is up. Shares are decreasing, which is good. They don't have enough.
Profit margin was good.
Profit margin? I'm sorry. I said good. Yeah. Oh. Good. And their free cash flow growth is up. But at the moment, you're not in love with this. You're not in love with this company.
Yeah, it's just because the uncertain future. We just don't know the future certainty of it. Now, I haven't done any research on them. I have no idea. I didn't even know they did. I didn't even know they had Humira. So what do I know?
Paul, we've been going for a long time already. It's already 1:30.
Wow.
It's incredible. If you're hopping in and out, make sure you smash the thumbs up on your way in and out. We appreciate it. And Paul, we definitely have some more requests off the Patreon line and off the chat line. And now, ones from two of our patrons are asking for Johnson & Johnson. Isn't this one of Warren Buffett's favorites? The Johnson & Johnson's very classic, safe stock.
I don't know if he's ever said that. I have no idea.
Oh, okay. I thought this.
You want to look at Johnson & Johnson right now?
Please do.
Okay. Johnson & Johnson. Everybody knows Johnson & Johnson. They make Band-Aids.
Hold on a second real quick. We have someone from the UK, Brat Bike, is saying you should do a video on all the stocks that have 8 pillars. You are in luck, because if you join the Patreon, tell them what they get, Paul.
The other day on the Patreon, I gave the list to everyone who's a Patreon of the 47 companies that have all 8 pillars checked. So what I did was I picked U.S. headquartered companies over $100 million in market cap. And there were 47. A large chunk of them were banks, which is a little misleading. But there were 47. I put the list in Patreon. That's what you got to pay for access for. $8 a month gives you the app and the website for free when it comes out. And you get access to me to be able to do these little nuggets here and there.
What you will get in the Patreon is Paul's full portfolio, what he's buying, selling, calls, and puts, as well as mine, which is not as exciting, Paul, but it is a portfolio of a general person who I have a pretty damn good saving for someone who's 39.
By the way, every show you say a different thing. I have no money. I'm rich as hell. It's like every single show.
Well, I mean, something to be proud of. Paul has educated me that the money I have saved will turn into a lot of money compounding over a bunch of years, and it brought me a lot of peace of mind, Paul. You know that. That's for exactly sure. So all right, Johnson & Johnson, baby, let's do it.
$400 billion company. This is a big company.
Wow.
PE ratio X. It's 24. Pass. Profit margin 17%. Check mark. With a 67% gross margin.
Wow.
Dividend yield 2.7% on $4 billion. $400 billion, we'll call it $10 billion on the nose again. Just to make it even, it's a little over $10 billion. Let's just call it $10 billion. So we have an X, and a check mark.
Now, Chris is saying this is bum powder company. You don't sprinkle
Oh,
this
I
stuff.
don't do that.
You don't
do you?
sprinkle. Now, recently I saw some scientific reports come out that sprinkling on your undercarriage is cancer. There's cancer causing stuff.
Everything causes cancer.
Yeah, I know. So I switched, Paul. I switched to a more organic little sprinkle, and that's what I use.
Can I make a comment?
Go on.
3407. We were averaging 18 new subscribers a day.
We just got 7 in the past 20 minutes.
In the past 20 minutes, we got 7.
We welcome you if you're watching.
Thank you very much.
My 7-year-old is on, Paul. Dear Hank is on.
Hank the tank.
Doing the stanky leg. He came to your house last night, Paul.
He did. He's adorable. And you gave him candy, even though he wanted the other candy.
Yes. Let's do revenue. Thanks for all the thumbs up out there, guys. We appreciate the likes. Are we on revenue growth, Paul? Let's do revenue growth over the past 5 years.
70 billion to 82 billion. Check mark.
Okay.
There was a big jump right here. So something tells me on a company of this size, especially with how consistent their revenue was back here, that there was some sort of acquisition that happened here. And we can look at that in the cash flow statement if I remember. But it is a check mark there.
Profit growth over the past 5 years, Paul?
Yep. Let's go to profit growth. Ready? 15.4 to 15.1. X.
Uh-oh.
Now, one thing I do want to add in here to look at. Operating income. This is the income the company generates before taxes, before taxes and before other income and expenses. So it basically shows you and before debt payments. So how is the company itself, if it was free of taxes, free of debt, and didn't have any other extra expenses and profit, like, they might have made an investment in something that worked out. This is what I want to look at too to see the health of the company, how it's doing. 18 billion to 20 billion. So it's growing a little bit, but as you can see, it's only up 25% in the last 10 years. So Johnson & Johnson is a very slow growing company, folks. There's not much excitement there. So when we do our multiples, we want to have even at 20 PE and 20 free cash flow, that's too high. I don't think that's justifiable for a company that size.
How about pillar number 5, number of shares outstanding? We want this going down.
2.77 to 2.65, check mark.
Okay. How about current assets greater than current liabilities, which is pillar number 6?
What do you think this is going to be?
I think they're doing fine.
So 57.5 billion and 38.8 billion, check mark there.
Cha-ching. Okay, great.
And they almost have enough cash on hand to pay off 60% of their debt, 55% of their debt.
Free cash flow growth, Paul?
Okay, kids, free cash flow growth. Oh, wow, look at this number. This is good. Look at this. Very low. It's about 20%, not even 20% of their free, operating cash they spend on capital expenditures. So they had 16 billion here and 20 billion here. So check mark.
It's growing. That's nice.
15.5, 17.8, 18.6.
Free cash flow growth average over the past 5 years is 17.5, Paul.
So not free cash flow growth, free cash flow average.
My apologies.
I'm going to sit there and say you got to multiply this by 15 because it's a good brand, but it's slow growing. What's 17.5 times 15?
263.
And they're currently at 400.
400 billion.
So we need the stock to drop 25%. No, 30%, 35%. We need the stock to drop 35%.
Okay, so what we did is we have the free cash flow average over the past 5 years.
17.5.
We multiplied that, which is pillar number 8, our price to free cash flow. We usually want that less than 20. Paul did it times 15 because
why is that?
This is a slow-growing company with not much of an exciting future, I would say, Paul. What'd you say?
Correct. I doubt it's going to have much growth besides acquisitions. In fact, we can look at the acquisitions and see what they're doing. So look at this, 5.8 billion, almost $1 billion, $35 billion acquisition, 4.5 billion, 900. So they're making growth through acquisitions. I mean, it's fine. It's just, it's more likely to dilute you because they might issue more shares. It's fine though. It just makes them a more established company. But I picked 15 for that reason. 17.5 times 15, and that equaled $260 billion. That's the value I put based on cash flow for the company. 260 billion? Yes. So and it's currently at 400 billion.
They're just overpriced. They're too expensive.
So you need to drop by 35%. The company's currently selling for $152, 35%, $50. So call it $100. I want this at $100.
Now, as a normal person, Paul, looking at this, I'd say that seems pretty drastic for a company to fall that much. Right. When was the last time it happened?
I don't know.
Shall we look?
We'll look.
And
probably a long time ago.
We appreciate your chats and your thumbs up. Paul, I just had my little
December of 15.
My little 7-year-old just said, "Love you, Dad." Isn't that cute?
That's adorable.
Really melts my heart. Folks, if you are watching, I'm a little heart-to-heart here. It's a Christmas season, and we really can't thank you enough for your support. Paul and I, Don and Nate here, we're just very thrilled that you're with us. My family, Paul, is completely enamored with this show. It takes up a lot of brain time in our lives. We talk about it all day. My kids are on right now. They watch. And boy, my 10-year-old is learning so much, Paul. He's absolutely in love with just listening to you, saving his money. We talk about PE ratios of random companies at dinner because of you.
Come on.
I'm telling you, it's incredible. So Paul, with all this said, with all the numbers and the math and the portfolio and your Mexico houses, what makes you really happy with all this? Tell me real quick.
So I just like teaching, so I'm going to be starting soon at Case Western Reserve Law School, free of charge, because I didn't want to have a discussion with them and saying, we don't want to. I just don't want to get paid. I just like teaching. I remember 7 or 8 years ago, I started teaching at Walsh, and I really loved it. And I just like teaching. And then when people would say, the problem was I didn't like teach. I thought I'd like teaching one-on-one. I don't like teaching one-on-one. I feel like that's too much invested in one person. Like on a day-to-day basis on our live streams, some people can't make them. They can make them sometimes. They can make. So imagine if I always had to deal with that. Plus, to get me one-on-one would cost somebody way too much money. I mean, we were talking about $2,000 an hour to hire me one-on-one. I'd rather teach the masses and say, hey, listen, these are my thoughts. If you're really dedicated to helping out, you can get more access and by talking to me and asking questions. But other than that, I just like teaching. It's a lot of fun.
I mean, in general, why did you not give up on this show? Like I said, folks, if you're just watching us, we had 87 subscribers January 1st of this year. Why did you not give up? And it's been 2 long years of you and I sitting in this room talking about this stuff. Why did you never give up? When you
like doing something,
I had gone through. Yeah, I had gone through some phases where I was like,
You're still going through the phases.
Yeah, we're still through. But like, what? Yeah, I mean, like, you're really committed to this thing.
Well, because I feel like I'm going to teach forever, so I'm going to do this forever. So if people want to watch, great. If you don't want to watch, fine by me. It's just one of those things where it's going to be here. So
yeah,
just might as well subscribe and learn. And the other thing is, it's unbiased in the sense that, and I don't mean this to sound arrogant, I don't do this because I need it. I do it because I like doing it. And that's the best way to come from it and say, hey, I'm doing this based on my analysis, what I'm going to do anyhow. And it's actually been more profitable for me just from the standpoint of the viewers have given me some good ideas for investments. Like I made about $5,000 on InMode. I made a Walgreens investment that so far is giving. I exited my InMode investment that we did on the air. Made about $5,000 on that one. Only investing $20,000 though. So I just enjoy doing it. I'm going to continue doing it. It's just my life passion of doing investing and teaching. And the difference is, though, I want to do real estate also, but real estate's just so much slower. That's what we found. Like people like the real estate, but it takes so much more money and time to get involved in real estate. Stocks, you can do it tomorrow. And stock prices fluctuate like crazy, which is awesome.
We thank you all for watching. Make sure you're smashing that like. Paul, I want to take a small break there just to thank people and let us know where we're coming from because as we've already described, we've put a lot of time and effort in this show, and we hope you guys are liking it. It seems like people are. So, do you want to look at another company, Paul?
It occupies my brain.
Some people off the request lines were saying, like, have we looked at Altria? We've looked at Altria.
Yeah,
before.
we've looked at. Yeah.
Let's look at this one.
This is British American Tobacco. Looks like they're foreign.
Now we have tons of non-U.S. patrons, Paul. They love us overseas. So
this is the tobacco business, guys. This is not a very listen. Overseas, in more less developed countries, tobacco can grow in terms of the market. Here in the U.S., it's a declining market. 50 years ago, half the people smoked. Now it's like 20%, right? Which is still, and it's declining every year. Countries becoming healthier, et cetera. So tobacco in general, you got to account for the fact that the future is not going to be as bright as the past, right? So it's going to be factored in when we talk about PEs and free cash flow multiples, et cetera. So this is a big competitor to Philip Morris. It's neck and neck with Philip Morris International to be the largest listed global tobacco company. Slightly larger than PMI on net revenue, but slightly smaller on volumes. $88 billion company. Here's the big kicker: 7% dividend.
Wow.
So what is that? 756 for $6 billion a year. $6 billion a year in dividend payments.
Wow. What's up?
Oh, you're not going to confirm that? Okay, sounds good.
Oh, no, sorry. I was reading comments.
Okay, gotcha. So it's about $6 billion a year. First things first, PE ratio, check mark. It's 11.
Thanks, Paul.
Profit margin, 24%, check mark, with a gross margin of 83. Guys, this is huge.
83?
Yeah. So they have a huge gross margin, a huge bottom line margin, and a huge dividend so far, and a low PE. So far, I'm getting a little tingle in my under.
That's what you get when you
area.
smoke a cigarette.
Yeah.
You only smoke after sex, though, right, Paul?
Right.
Let's revenue growth, pillar number 3, revenue growth over
So
the
about
past
once
5
every
years.
4 years.
Isn't that cute? Good for you, Paul.
Thank you. 20 billion to 33 billion check mark. But this is weird. 20 down to 19 to 25 to 32 to 33. Those are big jumps. So the question is, did they do acquisitions here? So it's still a check mark, but we have to figure out why there's big jumps there, especially considering, look at the previous 5 years. Very flat. So that's always a question about when you see big jumps with a big company, especially when the past was pretty stable, you got to wonder why that happened.
See, this I'm telling Paul, folks, if this is new to you and you're learning, it's never too early or too late to learn this stuff. Paul, my 10-year-old just says, oh, 83 cents per dollar earned. I like that.
What do you mean 83 cents per dollar?
The profit margin's 83. I mean,
profit margin's not 83.
I thought you said the profit.
Oh, the gross margin.
The gross margin.
Yeah, that's right.
I mean, it's just like incredible. Like
I'm telling you, Geo's 10. Nobody in this school, not even well, especially not the they don't know crap about this stuff, right? They don't know anything about this stuff. They don't know anything. And here's Geo talking about it. Geo's gonna be some stock market. Watch us have Geo being like the best investor of all time in like 30 years.
He'll be the
everything. Guess what? I started
money
investing
mascot.
when I was 13. He's faster than me.
Yeah.
He's sooner than I was.
He'll be 11 in April, so interesting.
Are we gonna have a pool party?
I hope so. If
it's April. It's freezing in Ohio State.
Right. Of course we will. Let's do profit growth over the past 5 years. Thanks everybody for watching.
6.6 to 7.3, check mark there. And going back to our comment before about operating income, 6.6 to 11.6. So
4 check marks so far, Paul.
So check marks here, and their operating income is showing growth. 6.6, 6.5, 8.5, 12.5, etc. So the business is getting better.
Have you ever had a cigarette, Paul?
So Andrew and I went to Hilton Head with our buddies the year we graduated. I was not even 18 yet. We were trying to get into a bar, so they gave me a hat and they gave me a cigarette and said,
mustache.
Go in there. And I started coughing right in front of the bouncer. He still let me in.
But like Bill Clinton, you didn't inhale, so.
Yes.
Let's go to number of shares outstanding. We want this going down.
This is not good, guys. 1.86 to 2.3 billion. X mark there. So that's an X.
Daniel, we were looking at BTI Tobacco. It's a British company, you said, Paul? Yeah, British. Of course it is. So stupid. Yeah. Yep. Go ahead, guys. Pillar number 6 is current assets greater than current liabilities, Paul.
20 billion versus 22.8 billion. So another X, guys.
Oh no.
Yeah. So 2 big ones here. They don't have cash on hand to pay their current bills. And they have a big jump in number of shares outstanding. I don't like that very much.
Free cash flow growth, Paul.
But here is the grand daddy of all daddies.
Let's go.
Okay, another company that spends about 10%, a very low number, less than 10% of their cash from operations on their capital expenditures. So going back here, 6.3 to 10.5, check mark. The other years are 5.3, 5.7, 12.5.
The average is 8, just basically 8.
Okay, so the average is 8. So in the last 5 years, they've averaged $8 billion a year in free cash flow.
Mm-hmm.
Remember also, their dividend yield was $6 billion. So last year they had about $10.5 billion in free cash flow. So it seems pretty safe. They've had a lot of increase in free cash flow. They've gone from 6.3 to 10.5. So 8, you have to understand, the thing that concerns me is not much revenue growth, but a big free cash flow growth. Not much operating income growth, but free cash flow growth. You got to understand why that is. But I think here, I would say this is a range of 15 to 20. So call it 120 to 160 billion dollars. What was the market cap?
88 billion.
Wow. Was it really?
88 billion.
So it's selling for 11 times free cash flow.
Wait a minute, Paul.
11 times free cash flow.
Wait a minute now.
Interesting.
Mm-hmm.
Interesting.
11 times.
Okay, so now that it's piqued my interest, the next thing I want to go through is what are my next questions that I have to go understand?
Please do.
This is why I need an analyst, because it's hard for me to go out there and do this stuff.
So again, my son is saying, is this a buy, Paul?
The things that bother me enough to say I'm not. I bought stocks going right there on the spot, like Walgreens. I was like, yep, I want Walgreens at this price, blah, blah, blah. This one I'm not, and here's why. I don't like this big jump. Okay,
what jump is that again? Shares outstanding?
Yes. Let's go to their free cash flow statement and look at their acquisitions.
How about momentum, Jared stating? Great point, Jared.
Yeah. Okay. All in good time, Jared. Look at this, $23 billion acquisition there. That's a big acquisition. $5 billion right here. So in a matter of the last 5 years, they've made about $30 billion in acquisitions. That's a lot of money, guys. That's probably why they issued all those shares. This was probably part of a big share. So you have to understand. Let's see here.
I loved you. Keep it up.
This actually isn't terrible. This isn't terrible.
Ariane, thanks for this being a subscriber. We did Pfizer just yesterday. Take a look. Yesterday's video. We checked out Pfizer as a company, and students. Our new friend from Latvia, Paul, wherever the hell that is. We welcome you.
Latvia and Lithuania, right? They're together.
Oh, Ayrton said, "Did we just break Paul?" That is interesting. You were stumped on this one, Paul.
I'm stumped in a good way. Because they issued shares to make an acquisition, right? This is where that big jump came from. They issued these shares. They also had another jump here, so I don't know why that is. They made a big acquisition. Their revenue's up.
Is it safe to say that more people around the world outside of the United States are going to pick up smoking in the next 20 years? I don't think the answer is yes.
I think as Africa develops more.
Africa, India,
I think
China.
It'd be interesting to see how that works. And this is an international company just like Philip Morris with a healthy dividend and a low multiple. And by the way, look at their PE, 11. Their free cash flow was 11. It just worked out magically that way. I'm not opposed to this one. Mo, let's add this to our little to-do list. Phoenix, I hope he's watching. If he's not watching, we should do some research on this one. He's in our Paul Super Shorts chat. He's a great researcher.
Jared, I would say that Paul has not been in love with the cannabis industry. There's just too many companies and too many.
Wait for everybody to die. But wait for all the crappy ones to die off, the ones to go bankrupt. Wait for the good ones to pop up and surface to the top.
David, our patron, says Southeast Asia smokes like a chimney. That is true. Remember that video, Paul? That 2-year-old smoking? You ever see that?
That's a great one.
That little chubby dude?
Yeah.
And he was just flicking it like he was on Mad Men.
Nothing's better than a chubby dude, a chubby little kid on Instagram. All right, guys, I kind of like this. I think we should do more research on this one to find the qualitative aspects.
Wow. Okay.
Look at this. The company holds 31% of ITC Limited, the leading Indian cigarette maker.
Oh, boy.
Dot, not feather.
Can you say that, Paul?
What?
Are you allowed to say that?
Probably not.
Okay. Let's edit that one out.
Yeah. Josh is still live, though. So
whoops. Okay, gotcha. And Dimitri, we don't talk about cryptos too much. Paul does not like those. There's no substitute.
So this is a great thing about our live streams. This is an investment idea now that I can go do some research on. This is why you guys need to be on these live streams. It gives us investment ideas. Now, I don't know if they have puts on this thing, but let's look at the technicals right now. It just crossed under the 300-day. 200-day just crossed under the 300-day recently. If you see back here, it crossed over here, which was right about $55 a share, crossed back over 37. All right, so you just save yourself quite some heartache over here. All right, let's do another company.
How about HP?
Love HP.
Why is that?
I don't know. HP is a big company. I think they're underrated. I think they fly under the radar as a big tech company that just doesn't get a lot of credit. I haven't looked at their financials in a while, but this will be a good time to look at it.
So coming from a normal person, Paul, we know we're going to have our 2 p.m. jump here when people get on the show. But go back to that. Go back to Y charts real quick. Just coming from a normal person, I say to myself, it's $24, so it's affordable.
Whatever that means.
Yes. But it's going
You sound like our Algebra 2 trig teacher who I wanted to throw a
And Paul, guess what? Like
school.
our other people, it's going up. What would ever stop this? It sounds like this is going up. Let's go. Why don't we get on the horse here and get after it?
Well, it was also going up here, crash. It's also going up here, fall. So listen, this matters on technicals, but we're looking at fundamentals versus technicals. Let's just worry about the fundamentals right now.
Okay, keep going, Paul.
Okay, so HP, I believe they're based. Oh, aren't they moving to Texas also? Does anybody confirm this? Can I make a plea out there to all the Fortune 500 CEOs watching me right now trying to learn?
Go on.
If you are in California, please move your company to a better state that is more cost effective, that doesn't kill you in taxes, and doesn't take 2 hours round trip, 2 hours each way to get to and from work. Please leave California.
Of course, David Spicer says they are. David, you might as well just be our podcast liaison because he looks that stuff up whenever he looks it up instantaneously.
All right,
going.
HP, $31 billion company. We'll call it 30, 3% dividend. That's $900 million a year. Let's call it $1 billion just to be safe because we rounded down here.
What is their PE, Paul?
PE, 12,
nice.
check mark. Profit margin, X, 4%. Gross profit, really low, 17.5. I'm actually surprised to see this. Why is their gross margin so low and their profit margin? I would have thought higher.
Yeah, this is like
maybe
retail.
It's hardware, a lot of hardware in them. Maybe hardware doesn't have a good. Anyhow, so we want to make sure that their free cash flow is well over $1 billion a year to support that dividend.
How about revenue growth? Pillar number 3.
48 billion to 56.6 billion. Check mark. But as you see, they went up, and then fell. So I don't know if this is because of selling something or not. But look at this. They were 126 billion in 2011. They split something off. I don't remember what it was, but they did split something off in 2014 or 13 or whatever, end of the year, or sell it off or something. The bottom line is you have to understand where this revenue is coming from because it's not very consistent. And for a big company like that, you want to make sure you understand that.
Jared Sauber said Dell is also low margin. Don, is Jared a patron? How does he know?
Is Dell low margin, really?
That's what he's saying. You better be, baby. All right, let's do pillar number 4 is profit growth, Paul.
All right, we have 2.5 billion to 2.8 check mark, but a peak of 5.3 here in the last few years. So it's a check mark, but it's very inconsistent profit.
How about number of shares outstanding?
One thing I'm going to do, though, really quick. I like talking about this operating income.
Oh, Jared's a patron. Okay, great.
4.4 to 3.7. So their operating income is getting lower and lower. That's not a good thing, but okay. Number of shares outstanding.
Yeah, pillar number 5. Sorry about that, Jared. Love you.
1.73 to 1.41. Check mark there.
Nice.
Okay, next one.
We have all check marks except profit margin, Paul.
Really?
Current assets over current liabilities.
Did you speak too soon?
No, I didn't.
20.6.
I'm actually writing them down, surprisingly.
26.22.
What's that?
X.
For
current assets over current liabilities. X.
Okay, no good. How about
all right, free cash flow growth.
Free cash flow growth.
All right, kids. 2.8 to 3.8, roughly. Check mark. Then 3.2, 4 billion, and 4. Average?
3.5.
3.5. Not much growth here, guys. I'm going to pick another low multiple. 12.
Why?
It's just low. Their PE is 12. Free cash flow. You're going to get your... Oh, by the way, the great news is their dividends were $1 billion. They have plenty of money to pay that dividend.
That's good stuff, right?
That is a good thing. Plenty. 3.5 times more money. This is good.
Price to free cash flow.
So $40 billion company.
Their market cap
might be a buy, guys. It was at $31 billion.
You're right. Might
be a buy. Trader Mo, add it to our list. We're going to look at the puts today. See if we want to pick up some shares here in the short term, generate some income from that. HP is a big company. You know, so my friend Gary, friends of Mo, I've invested in Gary. He likes going for very, very, very small companies because you're going to get more return from small companies. They're overlooked, not many analysts. I like buying bigger companies with established brands that have a hard time going away. So I like HP as an idea. I want to sit there. I think their printers are good. The question is, how important are printers going to be in the long run? What else do they do? What does HP even do now? See, if I ask that question, that's why I know I have to do more research.
Mason's saying that Sabre printers are much better than HP.
Mason's also a moron, so... Sabre printers? I don't get it.
Paul, how
dare you. Is that The Office?
Yes.
Okay, gotcha. Thanks, Mason. You're funny. I take that back.
Students from Latvia said HP cut their dividend. That's just, forget it. No, that's not correct. Sorry, guys.
They increased it.
I'm crazy. Hold on a second.
I love Mason. Don't get offended, Mason. Don't get your panties in a bunch.
Kurt, this is a great question. And look at this last name. Schwackelstucker? Wow. Paul, if you blindly bought every company that checks all 8 pillars, do you think the portfolio would outperform the S&P? Holy cow.
That's a great, great question, and one that I don't exactly have the answer to yet. And when I get my Morningstar data, I will be able to backtest that, but only 10 years. I don't like only backtesting 10 years, but it is a very good question we've talked about. And the other thing is, remember, I don't think you should just buy based on the 8 pillars. So We should see how it does, but we'll see how it goes from there.
Tony, welcome. He said HPQ is mostly consumer printers, PCs, and laptops. HPE is enterprise, data centers, and software servers.
Okay, what does that mean? That's two different divisions of the company?
Probably, but still the profit margin at 3%, right, Paul?
5%, not even.
Yeah.
But you know what? They're a very established brand. Who knows? I'm not opposed to this, though.
Inca Warrior
You know what else I like?
Go on, Paul.
The analysts don't like it.
Why is that?
Why is what?
Why do you like that?
Because analysts are stupid. So I'm going to sit there, and they're going to be manipulated by what the stock is doing because they don't want to look stupid. So the stock's going nowhere. They're going to put this thing on a hold thing. Buy recommendations are 5, 1 outperform, 3 underperform, no sells. You're telling me, by the way, try to find me how many sells there are out there. Not many. But I like the fact that everybody's negative on them. That's a good thing.
Moose had said they're two different companies. They spun off of each other. So
that's probably the big. That was probably the big drop in revenue back in the day.
2 divisions, 2 stocks. Okay, got it. Okay, and they have a personal server segment. Thanks, Chris and Tony. Appreciate it. And TWC there. All right. Okay, great. Paul, do you want to keep going? Do you want to take some off the request?
It's 2:00. Can I take a water break real quick while you keep talking?
Yeah, well,
I think we hit probably a record in terms of concurrent viewers. I saw 92 at one point.
Yeah, folks, Paul's going to take a short break from talking for an hour. I will privy you to the amazingness of our Patreon.
Seth, you want something to drink?
Paul doesn't know that he's mic'd up. So,
Oh, yeah.
Paul, folks, if you're lucky enough, one day Paul will go to the bathroom with his wireless mic on.
I've done that before.
And we will hear
Seth,
everything.
Do you want something to drink or not?
Yeah, yes, give me water.
Okay.
And we will hear
Jesus
Paul
Christ.
sprinkling the toilet seat and then leaving, most likely not washing his hands. This is the content you're going to get here on the Everything Money channel, and you'll get more of it on Patreon. And I'll tell you what we're going to do. If you join Patreon, you will get Paul and I on a monthly basis. We do a fireside chat at his home with Trader Mo. It's a uncensored conversation with just our patrons only, and you guys can ask any damn question you want. We love it. And so join the Patreon, join our community, and let's all go make that cheddar, right, Paul?
Let's go make that cheddar.
Okay. What is Paul? Can we look at AMT?
What is AMT?
I don't know, but our friend has asked for it about 17 times, and he's been on for the entire hour, so I'm going to reward him with that one.
American Tower Corp. Owns and operates roughly 180,000 cell towers throughout the U.S. Leases space on its towers to wireless service providers, which install. So let me ask a question.
Go on.
These towers, are they going to become obsolete with satellite? Like, at what point is the satellite just going to become, like, just everybody sending satellites to space and just relay everything?
I have no idea.
I think that's a legitimate question.
Cell towers?
Yeah.
I even think cell towers are here to stay because
they're so much ugly. They're going to figure out a better way.
They're so easy, though, Paul. They dress them up as trees nowadays, and I think they're going to get better.
You see that one outside my window at the freaking house in Mexico?
Oh, yeah. Did they get rid of it?
No, of course not. The guy makes $1,500 a month off that thing.
It's very ugly. But no, like nowadays, Paul, you think about like, remember people would get those huge satellite dishes on their home to get like cable? And
guess what happened now?
They're like little,
that's my point.
Oh, it's completely gone. But the dishes are still small sometimes.
That's my point.
Okay, go on.
My point is towers versus satellite. I mean, every business has its ups and has its problem, and this might be one of them.
Hold on a second real quick. Don, do you see anything on your end?
What's going on?
Oh, someone just said there's a problem. There's lag. No. Oh, they're talking about something else. Oh, I see. Thanks, guys. Boy, I'm an idiot. Okay, here we go. Paul, let's look at this company. AMTB, I want to look at this.
All right. $98 billion company. We'll call it $100 billion to make it easy. Mm-hmm. PE ratio, 52.
Uh-oh.
Oy. Now, one thing I know about towers, when you build a tower, there's a lot of depreciation there. I wonder how much of that is driven by depreciation. We won't get into that now. 23% bottom line profit margin, check mark.
You gotta
72%
like
gross margin. That's beautiful.
Revenue growth over the past 5 years?
Okay. See, I can't wait to have our own website done where I just have all of these in a line.
Mm-hmm.
Oh, man.
What?
I was regurgitating my 4.8 billion, 7.6 billion. They had a massive increase.
You do burp up lunch a lot when you're talking.
We eat it right after, and I'm talking a lot. And all this stuff.
I know. It's tough. That diaphragm. I know. You're a warrior up there.
4.8 billion to 7.6 with some growth in between, but the last few years have not been the best. Let's see how they've done on their income. Income 685 to 1.9, check mark, almost tripled. Their operating profit, just to go back up here, operating income 1.6 to 2.7. Wow, pretty consistently growing too. That's good. Okay, so we have check mark there. Number of shares outstanding,
Pillar number 5.
418 to 442. X there. Maybe they made an acquisition somewhere over here. I don't know.
Allie Lurker just said, my first live stream. Welcome, welcome. Good to have you. Keep going, Paul. That is not good on shares.
Current assets, right? 2.85 billion. Current liabilities, 3.266.
People are saying AMT is a REIT. Is
it a REIT? It doesn't say it's a REIT.
Oh, that's a couple people are saying.
Is it a REIT?
Does it matter? What is that again, Paul? I still don't know. I'm sorry.
Real estate investment trust. It's a certain structure that's done by the IRS where it holds real estate and they have to pay 90% of their taxable profit out to shareholders. I don't think that's the case here.
3 or 4 people saying it's a REIT, but you want to keep going?
Maybe it is a REIT then. It doesn't say it's a REIT.
Does it matter?
It is a REIT right there. It says REIT.
Sorry. Is that bad? What is that?
It's not bad. It's just there is a problem with the depreciation.
I just spilled water all over myself. Keep going.
Cash flow.
Okay.
All right. 1.4 to 2.8. Check mark.
Mm-hmm.
2.1, 2.1, 2.8.
I wasn't ready.
There are the numbers up there.
This is free cash flow over the past 5 years.
Okay, I'm just gonna do it myself.
I got it, Paul. Just
1.4.
I got to fill the void with something. Divided by 5, it's 2.2. 2.25.
2.2 times. Give me a number.
You tell me, baby.
33 billion. What's it at now?
100.
Is it? I forget already.
It's 100.
Oh, well, have fun with that, guys.
What do you mean, Paul?
I mean, first off, I'll tell you one thing. They can't even afford their dividend. Boom. They have a $100 billion market cap, 2.2% dividend, 2.2 billion. They can barely afford their dividend. The average was 2.2 billion. Isn't that average? Is that what Delta is? No, that's not. Is that average? Whatever it is, it's 2.2 billion. Guys, I don't like the fact that's the case. Maybe that's part of the whole, they got to pay 90% of their profit in dividend. Because it's a REIT. I don't know. I just don't like REITs. I don't know why I don't like REITs.
You do not.
I don't like REITs.
Stephen has a great question, Paul.
Let's hear it, Stephen.
Going back to the 8 pillars. So if you don't buy, sell stocks solely based off the 8 pillars, what else would you use to buy, sell stocks? Why isn't there more pillars at that point? Which he chuckled a bit. And he loves us. That's a great question, Stephen. I mean, a very, very down-to-earth sort of question. Like,
why don't you try to answer that first?
Me?
Yeah, you've been around for a while.
Well, that's great. Stephen, I'll mess this up. But in general, I think that the 8 pillars gives us sort of a found. I called them pillars. We called them pillars because it's like it gives a foundation for maybe where you should start looking. And a lot of times now you can start in your head say, look, if that PE is already high, they start firing off warning shots to you about like maybe I shouldn't get involved with the hype stocks. And so Paul always says, look up the 10K. I've never done that. I mean, typically I want him to sort of, maybe like our viewers want him to sort of steer me as to where we should look into. But in general, this is just giving us a mathematical foundation of where we might want to start looking at companies.
That's a great answer.
Because, folks, I was in this. I was in your shoes. As I see everyone else talking about Tesla, and I just bought, right? Who cares? Just buy the hype. And then all of a sudden you start realizing that, wait a minute, these can crash down. NEO down, NEO down. I know from mid-November to just last week, NEO was down 22%. It must be back up. Okay, so there you go. But I mean, things can come crashing down. It's possible. So the 8 pillars is just a start. And I know a lot of our viewers want it to be the end-all, be-all. If Paul says so, let's go buy.
Nothing's ever the end-all, be-all.
And there are a lot of assumptions that Paul always says, and I'm eager to learn as well what they might be. So keep going,
Remember,
Paul.
So nothing I'm going to tell you is something you should just follow blindly. Gary is the best investor I know. I don't follow him blindly. I disagree with him on things. I look at bigger companies. He wants smaller companies. I might look at a company and say X, Y, and Z. He'll say, I don't agree with that one. It's all about how you assess it. You just want to make sure that you're seeing the counter argument for what you're saying. And if it makes sense, you go with it. If it doesn't make sense, you stick with your policy, your analysis. If investing was as simple as just follow the structure, the only thing to do that is saving. invest in your ETF, invest in SPY, invest in the S&P 1000, and roll with it. But investing isn't art. It's not this mathematical equation all the time where you sit there and put something in and say, I'm buying this. So who knows?
Paul, our 2 o'clock folks are jumping in. There's a lot of people jumping in. Like Chris, we did a whole video on AT&T just recently, Paul. That's another great dividend stock if you want to look at that, Paul.
AT&T.
A lot of people are asking about AT&T.
So, by the way, I put the Towers one into my Excel sheet. Look at the price it's giving me. Basically $50 a share. And I came up, I think my analysis said like $75 a share or something like that. So, remember, I'm trying to buy at a bigger discount than most people. So, it's about right.
I'm sorry. I don't know if our minds work as fast as yours. You're going back to the last stock we looked at. AMT. And you're saying that you're
my Excel sheet that spits out a value for me. And by the way, guys, I don't just go off this value all the time, but it's basically saying me pay $45 to $60. And this 222 number, I was sitting there saying it needs to drop by 2/3, which is $70. So we're pretty close to it. The bottom line is both my analysis and my Excel sheet are coming up with numbers that are pretty similar. So I got to look at that and say, okay, well, that's probably where I stand.
Let's look at AT&T, Paul. AT&T, as you know, we've discussed before on the show. My mother worked for AT&T.
Have we done AT&T like 18 times?
50 years. Well, it's good to update it.
What was that, Don?
I'm sorry, Don.
We did it Tuesday as well?
AT&T?
Yeah, last two, like two Tuesday, like not this Tuesday, the previous one.
All right, guys. Maybe go back a little bit and look at AT&T in terms of their dividend. Yeah, right, because they're buying HBO Max. We went over all that stuff, so it's in a former video. If you subscribe and look at all our videos, they're there. You can literally watch for the rest of your lives and probably not catch all the content we've thrown at you.
What about P&G, Proctor Gamble?
Yeah, sure. Let's do that one. P&G.
And their ticker symbol is PG.
That's you, baby.
All right, because it's a nice dividend stock. $340 billion market cap with a 2.3% dividend. Does somebody want to tell me what that is? Let's just call it $7 billion to be safe.
$342 billion. Okay.
Yeah, $7 billion in dividends need to be paid every year. PE of 26x. Margin, though, 22%, check mark, and 53% gross margin. So 1x and 1 check, but not turned off yet.
That PE doesn't scare you already?
Not yet.
Okay. How about revenue growth over
I don't
the past
like it,
5
but it's
years?
not great. 65.3, 71, check mark, but it was pretty stagnant, came down a little bit. So there's obviously some acquisitions and dispositions happening here. If you look back at 2011, it did 81 billion. So they probably sold something off over here. So it is a check mark still, 65 billion to 71 billion.
How about profit margin, Paul?
You mean profit growth?
Sorry.
Profit growth, 10.5 to 13, check mark. And operating income is growing as well. That's a good sign. That's excellent. Remember, operating income shows you how the company does without debt, without taxes, and without other income and expenses, how the actual company itself and what it does day to day is doing.
How about number of shares outstanding, pillar number 5, Paul?
I'm actually surprised. This is a check still, 2.7 to 2.5. I thought it'd be a bigger drop in shares. I thought a company like P&G would spend a lot of money trying to buy back shares.
They had profit growth last one, Paul, last pillar. They had profit growth?
Yes, they did.
Let's do pillar number 6, current assets greater than current liabilities. I got to look up a stock real quick, Paul. Keep going.
You do that. 26 billion in current assets, so basically cash on hand, and 30 billion in current liabilities. So that's an X, guys. We have, and I think the same thing occurred. Procter & Gamble is a lot like Johnson & Johnson. So I think we had the same thing with Johnson & Johnson. If I'm not mistaken, I think there was more current liabilities than current assets. So that's an X there.
X for current assets?
Yep, X for that one.
Free cash flow growth, pillar number 7, Paul.
Okay, free cash flow growth. Guys, another great low capital expenditures relative to operating profit. So 12 billion to 14.4. Check mark there. 9.6, 11.1, 12.
Free cash flow average of the last 5 years is 11.8, Paul.
Okay, let's call it 12 billion. What is their dividend?
I don't recall
7
the dividend.
billion. So they have enough.
Okay.
They have enough. Now, this is again a company. 15 times, 20 times. I mean, I think it's 15 on this one, if not lower. $180 billion company.
342, Paul, is their market
Yeah,
cap.
so it needs to fall in half, almost.
This company has to fall in half before you're buying.
I mean, 40% drop. And it makes sense. They're at 25 PE. A 40% drop would be 15 times PE, right?
Mm-hmm.
So it makes about sense. At the end of the day, the good news is your dividend of 2.3%, when the stock falls 40%, That's going to go to 7 billion out of 180 is 4%, a little under 4%. So you can get a much bigger dividend yield as well. So guys, be patient. You'll get a stock at a lower price and you'll get a higher dividend yield because of it. Can't go wrong there.
Will you look at MET, MetLife Care, a follower of ours?
Isn't MetLife an insurance company? I don't do insurance because insurance companies are like banks in the sense that you look at their profit a different way. If you read Warren Buffett's old annual reports, he talks about how insurance companies look at their profit and so I haven't learned that yet. I'm still just learning banks. So I do not go over insurance companies. I actually avoid them completely as part of my analysis, as part of my investments.
Is this a different place, Paul? MetLife Care is one of New Zealand's largest retirement village providers.
See, okay, I'm looking at MET.
Yeah, MET.
It's the largest life insurer in the U.S. by assets.
Well, Chris, I tried. I love you.
What's it called?
Chris requested this and it has been for an hour. Oh, MET dividend suggestion.
What?
Oh, that's what he's writing. Sorry. Right. He's thanking me. Great. Oh, a dividend. Got it. Okay, Paul. I have tons more suggestions. You want to look at some?
Let's pick a fun one.
Fun? Well, I mean, Lockheed Martin's been brought up a few times. LMT.
That's not gonna be fun.
No, you don't like the military? I'm kidding. That's a great way to not a great way to put it. Citigroup?
Bank. Ignore.
Malik, I'm sorry. GSK. TW is asking for GSK. What is that?
GlaxoSmithKline, another drug company.
Want to look at it?
Let's look at it.
Let's look at it. There you go,
okay.
TW. Here you go, baby.
I believe they're based in Indianapolis. Actually, maybe they're international. Okay. Pharmaceutical industry ranks as one of the largest companies by total sales, wields its might across several blah, blah, blah. It's respiratory oncology, which I knew. Glaxo also uses joint ventures to gain additional scale in certain markets like HIV and consumer products. So guys, another pharmaceutical company, go figure out their pipeline. Do they have drugs coming off patent? Do they have a good pipeline coming in for new drugs? Very important for that business.
Dr. Dathy joined us, one of our OG followers. Paul, what company is this again? GSK?
GlaxoSmithKline.
Okay, keep going.
$95 billion market cap, 5.5% dividend. Let's call it $5 billion a year in dividend.
5.5, that's good, right?
Yeah, that's real good.
Nice.
PE, check mark, 11.6.
Ooh, okay.
Profit margin, 14%, check mark.
Hey.
With a 67% gross margin. So good stuff so far, kids.
Hey.
Good stuff so far.
Revenue growth, Paul. Profit growth. What are we doing? Revenue growth over the past 5 years. Pillar number 3.
Here we go. 36.6 to 43. And the thing I like about it, guys, is it's consistently growing and not by big leaps. So it's more likely this is done naturally, but we'll look at the cash flow statement to see. And we might want to add that into our analysis, not as a pillar, but just look at the cash flow statement and see how many acquisitions they're doing. So remind me of that. So it's a check mark here.
Revenue growth. I'm sorry, profit growth. Pillar number 4.
Profit growth.
What are we going to add, Paul? I just lost you that last one. We're going to add.
Jesus Christ.
We're going to add.
On the cash flow statement, how many acquisitions and dispositions they do. Okay, income. Ooh.
What? Tell me. We can't fee.
12.9 down to 5.9. There was something up here.
Uh-oh.
Okay, here it is.
What happened, Paul?
They must have made.
Paul, look at the 10-year revenue.
What?
David says, look at the 10-year revenue.
Yeah, it's flat over 10 years.
Yes, very flat.
Flat like your mom.
Oh, Paul. You're
I do these for Don, because I think Don laughs at that. I'm going to ignore this $12 billion. Something obviously happened here. Let's ignore that. I'm still going to give this a check mark, 1.2 to 5.9. But this already tells me I have to do more research on this, understand even how they went up 5 times. That's a big jump.
That was profit, Paul?
That was profit growth,
Let's do shares outstanding. We want this number going down.
It is actually going up very
CEO
slightly.
CEO changed. Dr. Dathy saying the CEO changed at some point for this company. But go ahead with shares. They're going up. Uh-oh.
Very little, but they're going up still.
Okay. How
so
about
an X there?
Current assets over current liabilities, Paul?
If I wasn't 8 pillar. 25.6 billion versus 28 billion. X.
No likey?
I mean, it's not. I mean, it's less.
Free cash flow growth over the past 5 years?
Okay, kids. A lot of money being spent here. 1 billion to 7.5 billion.
Wow.
check mark. 5.6, 6.1, 8.9.
That's about 30 divided by 5. So it's 5.8. 5.8.
30 divided by 5. Oh, yeah, you're right, because it's 6.
Yeah.
So call it 6 here. And what did they spend on dividends? Crickets. Oof.
What's that, Don? 5? They spend 5 on dividends?
I think you're right, because it was $93 billion market cap at 5.5% dividend yield. You're right.
That is dangerous?
I mean, that's tough. I mean, they did $7.5 billion last year. It's 2/3 of the money. It's a lot. I mean, I don't know if it's good or bad, but either way, the average is $6 billion. The average is $6 billion.
What's the multiple
by
here?
15 equals $90 billion. And they're at 93. So maybe it's about where it's worth. I don't know if I'm excited about this one, guys. I don't know. I mean, we look at the cash flow statement in acquisitions, $5 billion. Actually, they sold stuff here. They sold stuff in all of these. These are all sellings. Net sell.
So we're looking at GSK stock, guys. 95 billion market cap. PE is good. The profit margin is good. The revenue is growing. The profit is growing. The shares, unfortunately, are growing, and they don't have assets over liabilities. That's not good.
They sold a big thing in 2015, which I'm okay with. Oh, by the way, that's probably why they had the big profit jump that year. It was a gain on sale of asset.
Okay.
So that's probably why they had that big profit number that year. Listen, I'm not opposed to this. Mo will continue to talk about more about the pipelines and things like that, but I'm not opposed to GlaxoSmithKline. I'm not in love with it. Let me see. What was it, GSK? Why is my analysis coming back at around $20 a share? That seems kind of low for it. It must have been most recent quarters were probably down. Because this doesn't do the full year. This does the most recent quarters, which is more recent. Free cash. Yeah, their free cash flow is down a lot in the last. Yeah. I'm not opposed to this, guys. I mean, you have to sit there and understand, like, the pipeline here is, if it's good, it might be worth. Now, I'm not buying. Oh, the other thing is I want a bigger discount than most people do. I'm not buying it at 35 or 37 or whatever the number is. I'm going to want to buy it. As a value investor, I'm trying to buy $1 for 50 cents. Like, I don't try to buy things worth it. If I think a company, if I sit there and go, I bet my life a company's worth $100 and it's selling for 100, I ain't buying it. I want to buy it for 70 cents or something like $70 or something like that. That's my goal, is to always buy it for less. So my price versus somebody else, but do I think this company is 25 maybe to 30? I don't know why it's coming at such a different number. Oh, that's why we said the numbers we did were based on the last full year. These numbers here are based on the most recent quarter, and there was a massive fall in the quarterly free cash flow. Massive fall, fell by 80%. So you got to factor that in there when you're doing all your numbers. And that's going to be the downside to your models. Your models aren't going to. Recently with COVID, it caused quarter-to-quarter aberrations that were to the plus and the minus, good and bad. Like all of a sudden caused profits to plummet, and it hurts your whole analysis. You got to kind of weed that out. But it also caused profits to skyrocket that were temporary. That's why before, in another video, we talked about Amazon. I think Amazon's big surge in sales is going to be a more permanent one. It's not going to drop back down. I think it's going to be a more permanent surge, and I think I'm okay with that. Other companies that have collapsed, that's not permanent. Carnival Cruise Line, Southwest, those aren't permanent collapses. They're going to get back into business. The question is, can they survive that stuff? So that's why there's a big discrepancy between those numbers.
Ayrton, who's been on for an hour and a half, he said, basically, if you could sum up Paul's life, it would be, I love puts because it lets me buy at my price. That is true, right?
I do like that a lot.
Yeah, and you get paid
and
to
I
do
like covered
so.
calls. It lets me sell at my price, too. And get paid for it.
Paul goes over options, calls, puts, covered calls, and puts on the Patreon. We do specific videos just for you guys, and if you join the highest tier of Patreon, you get access to Paul. Basically, he's just texting you all day, him and Trader Mo, and you get me just jumping in every once in a while with some comedic relief, Paul, comic relief. So, are you tired? It's been almost 90 minutes.
Let's just call it a wrap here.
Join us every Tuesday and Thursday at 1 p.m. Eastern. If you're all over the world, we welcome you. Paul does a video by himself in the evening to go over the biggest gainers and losers of the day. And every single day we're putting
we're just releasing a video at 7. It depends on if I'm like yesterday I missed it because I had a doctor's appointment and all that stuff.
But we're putting out videos every single day, guys.
2 times a day.
And
remember 9 months ago, we were doing 2 videos a week.
Yeah.
Now we're doing 2 a day.
It's incredible. Thanks for joining us. Jump on that Patreon. smash that like button, and good luck out there. We love you guys.